I think that there's 5 steps to success.
Is it really possible to go from nothing to millions in today's economy? Or is that just a fantasy? What separates the financially independent from those struggling paycheck to paycheck? Is it luck, intelligence, privilege, or something entirely different? If I told you that some of the wealthiest individuals in 2025 once had less than nothing, drowning in debt, struggling to make rent, would you believe it? Think about Ray Dalio himself. Before founding Bridgewater Associates, now the world's largest hedge fund, he lost everything in 1982 after a bad market call. He had to borrow $4,000 from his father just to pay his bills. Or consider Sarah Blakely, who sold fax machines door to door before turning her $5,000 savings into Spanx, a billion-dollar company. The real question isn't whether wealth creation is possible. The real question is what separates those who break free financially from those who remain trapped in the gears of the economic machine. Understanding Ray Dalio's economic machine isn't just about knowing how markets work. It's about positioning yourself within that machine to generate wealth rather than just survive it. The key insight from Dalio's economic machine is this: economic cycles are predictable, and wealth is created by positioning yourself correctly within these cycles. It's not about timing the market perfectly, it's about understanding the underlying patterns. But here's where most people go wrong. They focus on saving money instead of understanding productive assets. Let me explain. There's a concept in economics that says, capital seeks the highest return. Whether you're religious or not, this principle is undeniable. Wealth creation isn't about hoarding cash. It's about deploying capital where it generates the highest return, and that requires understanding how the economic machine works. Think about it. What do we call productive investments? Assets. What do financially successful people accumulate? Assets that generate cash flow. What do the highest paid people in the world master? The ability to identify assets that will appreciate in value or generate significant income. Wealth is the result of owning productive assets, and here's the critical insight. In Dalio's economic machine, cash is actually a depreciating asset during inflationary periods. It's a fundamental law of economics. A well-diversified portfolio with assets across different classes can weigh thousands of pounds in value. But the only reason it grows is because of the productive energy of those assets working for you. That means your investment mindset must operate at a higher frequency than the average person's. What do you believe about assets, about market cycles, about your own capability to build wealth? Your understanding of the economic machine determines what opportunities you see or miss. Now go to the comment section and add this: assets create wealth in Dalio's economic machine. When I see your comment, I will know you understand this crucial principle. Now that you've commented, let's continue with Dalio's insights on productive assets. Before we go deeper into the specific steps to generating wealth in this economy, I need to ask you something. Do you truly believe economic cycles are understandable and navigable? Because if your answer is no, then everything we discuss next will be pointless. But if your answer is yes, then let's talk about how to make wealth creation inevitable by working with these cycles rather than against them. Step 1. Understand productivity and economic energy. Imagine you're looking at the global economy from above, watching trillions of dollars flow between businesses, governments, and individuals. You don't think about each transaction. You just see the overall patterns. But here's the truth. That economic machine isn't powered by speculation, get-rich-quick schemes, or even luck. No, it's fueled by one thing above all: productivity. Dalio explains that productivity growth is what ultimately drives long-term economic expansion. And what's more, if the productive sectors of an economy falter, the entire system struggles to generate real wealth. Now, why is that important? Because your personal wealth is directly tied to your relationship with productivity. It's a high-energy economic result, and if you want wealth, You need to be connected to highly productive assets or be highly productive yourself. But ask yourself, what kind of economic energy are you creating or capturing? Are you the kind of person who generates value others want to pay for? Do you own assets that produce goods, services, or experiences people desire? Or are you just clinging to cash while inflation erodes its purchasing power? Next time someone asks about your financial strategy, stop saying, "I'm just saving for a rainy day," or "I'm playing it safe." You think these are prudent responses? They're not. They're responses that ignore how the economic machine actually works. Think about the most successful investors today, whether it's Ray Dalio, Warren Buffett, or Cathie Wood. When they speak about wealth creation, do they focus on saving money under their mattress? No. They focus on owning productive assets that generate cash flow, appreciate over time, and outpace inflation. So here's the first wealth principle from Dalio's economic machine. Be connected to high productivity assets. Wealth flows to those who own or create productive assets. No one gets rich by hiding from the economic machine. They get rich by understanding it and positioning themselves within its most productive sectors. Add this to the comments. Wealth flows to productive assets and people. When I see your comment, I'll know you're following the economic machine's logic. The difference between the wealthy and the struggling isn't just knowledge, it's applied knowledge. It's understanding that in Dalio's economic machine, your energy must be directed toward acquiring or creating assets that produce value for others. Most people exchange their time for money, but the wealthy exchange their money for assets that generate more money without consuming more of their time. That's not just a strategy, it's a completely different relationship with the economic machine. Step 2. Wealth is measured in time, not just money. Let me ask you a question that might reshape your entire perspective on economics. Is a person who makes $1 million rich in Ray Dalio's framework? The answer? It depends. Let me give you 2 examples. Person A makes $1 million a year, but works 80-hour weeks managing complex investments and has 0 free time. Person B makes $200,000 a year from passive income streams that require just 5 hours of management per week and has complete freedom. Who's truly wealthier? Most people assume person A is wealthier, but Dalio's perspective on quality of life suggests otherwise. If they're spending all their time managing money, are they really wealthy? In the economic machine, wealth is not just about how much money you make. It's about how much time you control while your assets work for you. Add this insight to the comments. In the economic machine, true wealth is measured by time freedom, not just dollars. This is a fundamental principle that separates economic thinkers from financial followers. Think about what Ray Dalio has achieved with Bridgewater. He created systems, principles, and investment approaches that eventually worked without requiring his constant attention for every decision. On the other hand, many high-earning professionals, doctors, lawyers, executives make great money but are enslaved to their calendars. If you have no control over your time, are you truly benefiting from the economic machine or just powering it for others? This is why most people stay stuck financially. They chase higher incomes without creating or acquiring assets that generate passive income. The real question Dalio's economic framework pushes you to ask isn't, how much money do I want to make? Instead, ask, how can I own assets that generate income without consuming all my time? How can I benefit from economic productivity without sacrificing my life to it? How can I position myself within the economic machine to capture value rather than just create it for others? Because if you don't own productive assets, you don't control your financial destiny. And if you don't control your financial destiny, then economic cycles control you instead. Consider this. What's your current hourly rate? $20? $50? $200 per hour? Now imagine assets that work for you 24 hours a day, 7 days a week. That's 168 hours of productivity each week versus your limited 40 to 60 hours. Can you see how someone earning less per hour but leveraging assets can ultimately create more wealth with less personal time invested? Step 3. Understand the 3 key cycles. Dalio identifies 3 crucial economic cycles that every wealth builder must understand if they want to position themselves ahead of the masses. First, there's the productivity cycle. This is the long term, typically 75 to 100 years. Growth in our capacity to produce more with less. This is the fundamental driver of all lasting economic advancement. Understanding this cycle helps you invest in emerging technologies before they become obvious to everyone. Second, there's the long-term debt cycle, typically lasting about 50 to 75 years. This is where debt gradually increases throughout an economy until a deleveraging occurs. Understanding where we are in this cycle helps you position assets correctly to benefit rather than suffer when debt levels become unsustainable. Third, there's the short-term debt cycle, lasting about 5 to 8 years. These are essentially the business cycles of expansion and recession we experience regularly. Central banks raise and lower interest rates, economies heat up and cool down, and assets move accordingly. When you understand which phase of each cycle we're in, you can make more informed decisions about which assets to own, when to be defensive, and when to be aggressive with your capital deployment. It's like having a financial weather forecast while others are constantly surprised by economic storms. Let me ask you this. If you knew with reasonable certainty what the economy would look like in 2 to 3 years, how would that change your investment decisions today? That's the power of understanding these cycles. You can position yourself now for what's likely coming rather than reacting after it's already happened. Step 4. Diversification is your protection. Dalio's famous all-weather portfolio strategy teaches us that diversification across uncorrelated asset classes is the key to surviving any economic condition. Don't put all your eggs in one basket, whether that's stocks, real estate, bonds, or any single asset class. Instead, understand how different assets perform during different economic phases. Some assets thrive during inflation, others during deflation. Some perform well during economic growth, others during contraction. By spreading your capital across these different asset types, you ensure that portions of your portfolio are working for you regardless of current economic conditions. This isn't just about avoiding losses. It's about having capital positioned to take advantage of opportunities in any environment. Think about 2020. While many businesses were devastated by the pandemic, others like Amazon, Zoom, and Netflix soared. Or consider 2022, when inflation and rising interest rates hammered technology stocks but boosted energy companies and certain commodities. True wealth builders had exposure to both, allowing them to weather the storm and even profit while others panicked. Comment with, diversification across economic cycles is the key to sustainable wealth. This principle has helped Ray Dalio weather every economic storm for decades. But here's what most financial advisors get wrong about diversification. It's not just about owning different stocks or spreading money across random asset classes. It's about understanding how assets respond to the specific economic environments of inflation/deflation and growth/recession, and deliberately constructing a portfolio that can thrive in any of these conditions. Dalio recommends approximately 25% of your portfolio in each of 4 quadrants: growth with inflation, growth with deflation, recession with inflation, recession with deflation. This approach ensures that regardless of which economic season we're in, portions of your portfolio will thrive while others may temporarily struggle. Step 5. Understand money and credit. One of Dalio's most powerful insights is understanding that money and credit are different sides of the same coin in our economic system. Most people focus exclusively on money, completely ignoring the much larger credit markets that actually drive economic activity and asset prices. When you understand how central banks influence money and credit through interest rates and monetary policy, you gain a tremendous advantage over average investors. Interest rates are essentially the price of money over time, and this single variable affects virtually every asset class in the economy. When interest rates rise, certain assets tend to fall in value, particularly long-duration assets like growth stocks, bonds, and real estate. When rates fall, these same assets often surge in value while others lag. By understanding this relationship, you can position yourself ahead of major market moves rather than reacting to them after they've already happened. Let me give you a concrete example. In 2020 to 2021, when interest rates were at historic lows, investors who understood this relationship loaded up on assets that benefit from cheap money, technology stocks, real estate, and other growth investments. Then in 2022, as rates began rising aggressively, those same investors rotated capital into energy, value stocks, and shorter duration assets. This wasn't luck. It was applying Dalio's principle of understanding the relationship between rates, money, and credit. The question isn't whether interest rates will change again. They absolutely will. The question is whether you'll be positioned properly before these changes become obvious to everyone else. So here's your challenge today. Stop being economically reactive. Stop thinking only in terms of saving or spending. Start thinking in terms of owning productive assets that generate income regardless of economic conditions. Remember what Ray Dalio teaches: the economic machine has recognizable patterns. It's not random, and it's not designed to keep you poor. In fact, it offers incredible opportunities for those who understand it. When you align yourself with productivity, diversify across asset classes, understand economic cycles, and focus on time freedom rather than just money accumulation, you're not just participating in the economic machine. You're positioning yourself to capture the wealth it generates while others remain cogs in the system. The economic machine will continue running whether you understand it or not. The only question is, will you be carried away by its currents, or will you harness its power to create the wealth and freedom you desire? The choice, as Ray Dalio would say, is entirely yours. But remember this: the economic machine doesn't care about your financial dreams or goals. It simply operates according to certain principles. Those who understand these principles prosper. Those who don't struggle financially. Where will you be 5 years from now? Still working the same hours for slightly more pay? Or will you have built an asset base that generates income while you focus on what truly matters in life? If you found value in this explanation of Ray Dalio's economic machine, make sure to like, subscribe, and share this video with someone who needs this perspective. Remember, in the economic machine, knowledge isn't just power, it's wealth waiting to be created. The patterns are there for those with eyes to see them. The opportunities exist for those prepared to act on them.